Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry weekly recap, as well as your fresh intraday market analysis webinar. It is currently January 7th, 2024, just into the fresh weekly market open, about to head into Asian session hours. Now, we're just going to start off with a quick review of some of the main important events that took place from last week, and then be diving into our fresh fundamental and technical analysis, looking at market sentiment, what economic events we have on the table, what's in focus, even forecasting deeper into the week, and then obviously translating that information into some trade ideas. Now, last week was quite interesting due to the market timing, as we were, of course, starting a fresh new business year, and we were just coming off some of the global holiday periods through the Christmas period and obviously through the New Year's period. You can see in the example of gold, US dollar, and US equities, to start out the new year, we saw a little bit of profit taking against the current trends we've been seeing. In the example of gold, US dollar, and US equities, the primary fundamental driving factor has, of course, been the hopes of earlier rate cuts in 2024, being supported by the dovish undertoned FOMCs, declining inflation reports, and so forth. This fundamental driving factor has kept gold more bullish, US stock market more bullish, and dollar more bearish. But you can see to start out into the new year, we just started to have a pullback phase against those current trends. Gold having a pullback from these intraday highs, digging back into the rough 2040s. The stock market showing exhaustion from new all-time highs being printed into the new year from around the 37,800 handle, just having a slow correction into the 37,400s. And we can see because the rate cuts narrative has been a lot more bearish from the dollar, and overall bearish market structure when you're looking at dollar movement here to start out the new year, we just saw some profit taking from sellers in a pullback phase, which is still respecting bearish market structure. So there wasn't really any important events last week. It was just interesting to see some of the order flow and price setups into the new business year, and just seeing a little bit of a cool down from that narrative that's been holding the most weight from October and November, which is, of course, the market's pricing in earlier hopes and expectations of rate cuts into 2024, right? Now, the main important event that did take place last week was US jobs reporting, followed by some important PMI figure due to the change in data we saw. Now, NFP was basically a write-off. It was basically the algo sweeping orders on both sides of the market on commodities, equities, and even looking at currencies such as the dollar on the intraday timeframes due to having mixed data. The actual NFP data that came out was optimistic, but both private sectors reporting and NFP itself from the prior data report got revised by the Bureau of Labor Statistics and was revised to the downside, showing that previous signs of job growth wasn't as expected. It wasn't in those high numbers from the 190 to 200K mark when you're looking at the non-farm payroll change. It was actually much lower, giving us a general range from around 140K on the private payroll and around 170K on the non-farm payroll. This, on top of PMI data declining towards a contractionary point, dropping to around 50.2, that's what led to gold having these aggressive whipsaw moves on the intraday and not really showing us any one directional bias or any buyers and sellers in control. That's what, when we look at the candle price formations on dollar, led to a similar impact, spiking up, spiking down, ending up back in the middle. And we can also see that on US equities with the NFP move spiking up, spiking down, and then just seeing some very tight lower time frame ranges. So what does this tell us? Well, what it shows me is that the non-farm payroll data plus the PMI data in combination, as it's both important, is still not shaking the rate cuts narrative holding the most weight, right? Even though we're seeing some exhaustion on equities from these highs, it's still showing us the price anatomy of being very corrective structure, a secondary phase of market structure, a very normal, slow, controlled correction to maintain price balance and price stability after having such excessive upside, especially with the holiday seasonal Santa rally that was supported by the hopes of earlier rate cuts, right? And even though the NFP was optimistic, due to the revisions and the following weaker PMI data, dollar spiked up, but it still failed to break bearish market structure, which we were discussing in the market update webinars, is being validated below this price point, roughly from around 102.6 to 102.8, right? And even though gold had some aggressive volatility, it's still respecting bullish structure. Now, the one thing we have to look out for when we're going into this new week is that volume and volatility expectations are on the downside until we see some of the more important events unfold in the second half of the week, which in the example of a catalyst for gold, US dollar, so of course, US dollar pairs, even like crypto has been moving against dollar and so forth, right? For those who've been following along for the last couple of years and US equities, right? The main catalyst and focus in this coming week is CPI data, inflation data. Now, I'm going to talk about that obviously in more detail. The lab's going to be doing some webinars on that as well, deeper into the week. And of course, we're going to be doing our usual capital hungry CPI cheat sheet and live webinar during. But just as a quick reference, so you know what's coming, we have inflation data coming, and it's actually expected to edge a little bit higher, right? So this is what I was talking about and what the lab's been talking about over the last couple of market updates and educational webinars, where yes, since November onward, the rate cuts narrative has been holding the most weight. We've been playing it. We've literally been playing it since the dovish undertoned FOMCs, some of the declining jobs reports, declining CPI reports, Jay Powell fueling a dovish, Jay Powell with the dovish FOMC fueling the Santa rally in equities. We've been playing it, right? But what we also understand in the back of our minds from a macro perspective is that inflation is not just going to go down in a linear path to the Fed's goals and remain there nice and easy. Inflation is in the sticky zone historically, where we've seen a lot of fluctuations. And especially as we're starting to see geopolitical tensions bubble up and oil and other commodities such as natural gas starting to get some more buyer demand in it and prices rising on those commodities rising in price, such as natural gas, which has seen a bit of a rally on the intradays, oil has started to stabilize with the bulls back in control. That's going to lead to more increases in inflation for sure. And if the market's getting too ahead of the curve, pricing in rate cuts, yeah, it might help them out short term with stock market gains in terms of understanding greed and increasing profits, but it's not helping the economic picture on inflation, right? So inflation's still expected to be troublesome. It's not guaranteed to start showing signs of major fluctuation this report, but it is interesting that even though as we've had consistent declining reports with headline CPI starting to go back to 3% and so forth, that with this specific report, the forecasts are edged to the upside. The forecasts are actually expecting some slight increases in inflation. So let's just review two quick things with data here. One, the end of the week event with Friday's NFP of why it led to such mixed impact and not just the NFP due to the PMI data causing that data confliction. And then just looking at the CPI forecast, as we're going to have more information on that, obviously, as we get closer to it. So why such mixed market impact with all of the economic data during the North American trading session on Friday, January 5th? Most people, including myself at the time, were just primarily looking at the actual change. But the revisions on both non-farm payrolls and private payrolls, plus unemployment rate remaining the same, not dropping and not increasing either, This is what led to that data having a mixed impact, especially when we are looking at the lower time frame. Then, as this data could be primarily still seen as a little bit more optimistic, you can see what was important later on at 10 a.m. Eastern was the ISM non-manufacturing. This had what is classified in the economic data terminal as a surprisingly low result, right? The reason why it's surprising is because it exceeds minimum expectations on its decline. Yes, it was just a 0.1 drop below the minimum expectation. The minimum expectation for this data result was 50.7. It came out at 50.6, but still, at the same time, it's dropping below the minimum expectation. It's also getting a lot lower, sorry, a lot closer to being lower than the contractionary grade point, which is 50 flat, right? So you can say that we had some decent to optimistic jobs data, but when you're looking at ISM non-manufacturing PMI, which is still very important information, that was also surprisingly poor. And because it's lower than minimum expectations, it increases the amount of market impact it holds, right? And that goes with any data report. Like, for example, if non-farm payrolls, even though it was at 216K, which is still very good for this report, if it came out higher than 220K, 225K here, sorry, what you can see is the economists and bank contributions for their research expected maximum result for this specific report. If it exceeded that, it would have held a lot more weight. It was still good, but the data revisions take away from it. And then you just have data confliction, a tug of war between decent optimistic data to very pessimistic data, causing that indecision. That indecision being seen on different asset classes. Currencies, when we look at the dollar here, spike up, spike down. Stock markets, when we're looking at the example of the US 30 index, Dow Jones, spike up, spike down. And then when you're looking at commodities and precious metals, and in the example of gold, right, just spiked up, spiked down, ended up back in the middle. What we can mainly take away from this, with both data reports being absorbed and where price ended up, is that even though that jobs data may have been translated as short-term optimistic, it's still not enough to take away from the rate cut hopes narrative, which is still holding the most weight. And now, leading into my next quick review, the next focus point for, of course, dollar sentiment, well, the root being the next focus point for signals of Fed policy positioning, which is the root, which of course leads to impact on dollar as a currency, gold, US stock market, and so forth, is inflation data this week. So that is on January 11th. The main focus point is headline inflation here, right? CPI monthly change and yearly change are both expected to show a slight increase to 3.2%. Now, honestly, if it does slightly increase to 3.2%, that would lead to holding more market impact, that the fight on inflation is not complete yet, that the Fed still need to keep rates up, and it takes away some steam. It takes away some fuel from this rate cut hopes narrative that's been holding the most weight, right? Now, personally, I could still see inflation still being relatively steady at these levels, maybe still being at 3.1%, even still dropping to 3%, right? I still personally see this rate cut hopes narrative holding the most weight on the intraday time frame so far. It was highlighted with what we saw of the data result outcome on last Friday. And we have to understand that this rate cuts narrative, even though it may be overly priced in, overly greedy, it still supports that stock market greed. And we understand that's in the best interest of these corporations, funds, banks, politicians, and so forth. So I don't want to fight this stock market greed. Like, it's, look at this beautiful trend on equities. I don't want to fight this stock market greed and start just trying to call tops without proper confirmations. In this week specifically, If we don't get reactive events to induce new fear, uncertainty, and doubt, and that being a catalyst to lead to profit taking on the stock market by buyers from these highs and sellers jumping in hand, if we don't get something like more banking sector failures, which it looks like banks are pretty healthy with how the stock market's looking, if we don't get any new escalations with military tensions in the Red Sea, which it's been relatively controlled so far, we had some headlines over the weekend, but when we saw markets open in the gaps, there wasn't really any significant gaps. So no major market impact there. Or if we don't get any other type of reactive event, then it's very difficult for me to see any type of larger stock market correction. Even then, just from a technical standpoint, we don't have full reasoning for corrections and pullbacks yet either. We're still having buyers print these higher highs, and we're still having these short-lived corrective phases. So even from a technical standpoint, we would either need to show way more exhaustion at the same highs, or we would need to be breaking below 37 250s, 37 200s here on equities to at least be revisiting this last accumulation on the intraday timeframes before seeing buyers probably grab the dip again. So even if I wanted to see a correction from a technical standpoint, and which I would love to have the fundamental support for, we would need to be breaking below 37 200s there. Otherwise, you don't want to just get caught in a pullback phase trying to call tops and then boom, impulsive buyers still come into the scene with inflation still relatively low or stagnant and still not having anything to shake the rate cut hopes narrative holding the most weight. Because it's not just on US 30. We can see how order flow is moving through the markets as one on this rate cuts narrative, right? We can see that the rate cuts narrative has kept stock market more bullish, gold more bullish, and dollar more bearish. When we bring that fundamental information and translate it to the technical price points, US 30 still printed these higher highs and is still holding this first intraday liquidity zone, validating intraday bullish structure being respected at 37 200, right? Gold still printed these higher highs, had a minor pullback, and still respecting bullish structure, even if we get a deeper pullback phase into the 2020s again, right? And obviously inverse movement in dollar, we're still having sellers print these lower lows, even though we had that volatility on Friday with NFP in the data indecision, we still didn't break and close above this last price point validating bears in control here. So you can see how these institutional algos are still holding on to this sentiment of the rate cut hopes, feeding into the stock market greed, which is still going to keep asset classes like gold bullish and dollar bearish. The only catalyst we have this week from a data standpoint that could lead to a shift in this, with the first one being obviously inflation. Inflation will need to come out close to the maximum here or exceed it to hold more market weight for a dollar to be breaking above 102.8s, 103s and dig into the 104s, and for the stock market to be breaking below 37 200s and be dig into the 36Ks, and for gold to have deeper pullbacks back to the 1980s, even to like the 1960s again. Does that make sense? Everybody following along, understanding what fundamental narrative has been holding the most weight, how that's impacting dollar, which is obviously going to translate to dollar pairs, gold, US equities, right? So now that was just a quick little weekly recap and review on gold, dollar, US equities, which obviously that dollar information translated to like Euro USD. You can still see even after the NFP move, Euro USD still respecting this bullish structure inverse of dollar movement. GBP USD still respecting, oops, wrong chart loaded up here. GBP USD still respecting bullish structure. Dollar still respecting bear structure. Now, before we jump into the events we have to start out this week, expectations of volume and volatility, trade ideas and everything, we just want to do a quick review on yen as well. Overall, even though all of us are patiently waiting for Bank of Japan UEDA to give us another media leak or to sprinkle some more signals of policy tweaking, for the time being, they're still sticking to the ultra loose policy, and we don't really have any major fear, uncertainty, or doubt to spark appeal to Japanese yen safe haven side. Even then, even when we have had short-term fear, uncertainty, or doubt, because the primary driving factor of Japanese yen movement is the ultra loose policy of the cartel of the currency for the Japanese yen, which is the Bank of Japan, it still just ends up being short-lived pullbacks that get faded out, right? To me, we could still see the Japanese yen dig to these same historical lows, even lower before Bank of Japan gives the policy tweaking signals, sprinkling it over meetings and over leaks through the months to come, spread out into 2024. Does that make sense to everybody? Fundamentally, Bank of Japan is still sticking to the ultra loose policy. They still want to make sure inflation stays at these elevated levels above their 2% goals. They still want to make sure economic activity stays solid as global economic activity is starting to perish with rates being up higher for longer, right? For the other central banks, right? The other major countries. And that's still keeping Japanese yen in bearish market structure, which at least on the intraday time frames is being validated below the 72 price point. This means we translate that information to GJ, we do have a little bit of a resistance point here, but give or take a minor pullback to set up this new week, which I would prefer, even if we come all the way back down to 182s again. Don't really want to see us come all the way back down to 178s. I wouldn't mind, though. It would just be quite volatile, but I wouldn't mind getting better positioning from those low demand zones again. But if we're not going to be getting any policy tweaking signals from Bank of Japan in the near term, if we're not going to be seeing any major fear, uncertainty, or doubt catalysts just yet, right? Which Red Sea tensions haven't held too much weight on the Japanese yen, been holding a bit more weight on commodities there rather than the yen as a currency. Then give or take a pullback to the 182s or just trading above current prices, GJ could still easily be chugging to these last higher time frame highs back into the 186s, 187s, and 188s. And potentially still, if we don't get those policy tweaking signals, digging into those pre-Brexit crisis prices, which is into the 190s and 195s, before your boy Jeeve here is going to start to anticipate some very high risk, high reward sells before Bank of Japan starts to give us signals mid 2024 and catch some legendary generational trades. But don't want to get too ahead in this webinar. Right now, yen is still bearish. None of the data reports from last week or events from last week have shifted that sentiment. GJ is still bullish in terms of intraday price action, as we still respected the same demand zone here in general across the board, even though this was a short-lived Bank of Japan data leak move. But overall, from the 179s to 180s, we just have this last bit of a technical resistance point we can see here. If we don't break above there, we'd still love to get a bit of a pullback, but still looks like ranges to play back into these highs over the course of the next days and weeks to come. Right? But nothing much to really recap on GJ. Just the yen continued bearish after rejecting that sell supply zone and that bearish market structure retest point. The same time, GJ did a beautiful bounce from this demand zone and just had some very solid bullish price action. But that was just a quick little weekly recap and review, quick little fundamental refresher. talking about some of the events to come. Now we're going to dial in and look at what data we have to start out this fresh week, expectations of volume and volatility and why, and some trade ideas across pairs. So nothing really through the Asian session at all. Okay, to start off this week, we do have some economic data to be impacting euro currency specifically, of course, over the London session hours, specifically looking at German industrial orders monthly change, German manufacturing, German trade balance data, and then looking at Eurozone overall, some sentiment reporting, retail sales monthly and yearly change, and unemployment rate. German data is expected to see some slight rebounds, especially when we're looking at the forecast and minimum and maximum expectations change, as the maximum's looking a lot higher there. So they're expecting to see a bit of rebounding there. But then when we're flipping to Eurozone overall and looking at some of the consumer activity reporting with retail sales, expected to see decline in retail sales. So this means that there is the increased probability Euro can have some mixed sentiment overnight if we get conflicting data. The main important one is going to be unemployment rate, though, at 5 a.m. Eastern, looking at the labor market in the Eurozone overall. But the forecast is the same as prior, and minimum and maximum expectations really aren't that skewed in terms of the range. So not expecting much there. Then through our North American trading session, we don't really have anything going on, just your generic treasury bill auctions, which don't really hold that much significant market weight. From a central banking and political perspective, very quiet to start out this new week. Now, because we didn't get any defining information from the jobs report last week, because we're still very early into this new business year, because the next focus point for Fed policy positioning is US CPI, we can see less volume and volatility on gold, dollar pairs, and US equities to start the week. But that does not mean trade ideas can't play out or you can't get good trades. It just means you have to set your mental expectations accordingly. You can't expect that you're going to be taking a gold intraday trade. You have the take profit of 100 pips and you want it to play out in the next hourly candle. But if it plays out over 8 hours, that's pretty realistic to me, as long as the main important point is that the rate cut narrative is still going to be holding the most weight. When we're looking at that in the example of dollar, that means to start out this new week through the rest of the Asian session, London session overnight, and New York session, that means that dollar on the intraday fails to break above 102.8 or just continues bearish slowly back into these same lows. On the stock market, to show us that the rate cuts narrative is holding the most weight, we want to hold above 37,200s. On gold, we want to hold above the 2020s, even if we get a deeper pullback into there. Right? So that's still the main bias and narrative we're playing. So with the example of gold here, if we break below 2034, or sorry, 2028, I would see short-term downside just to this accumulation to the left here, where it looks like we were really supposed to be digging into with NFP. We just sweeped into it, but 2020 would have been a fantastic retest of this previous accumulation to the left near the key level. I can see short-term downside just to revisit the 2020s, but would still be looking for buys from those points, 2045, 2050, 2056, still just digging into the highs. So when we're looking at gold positioning here, I'm still primarily in the near-term prices looking for gold bulls. I can't even see a shift of structure unless we have a reason fundamentally for gold bears, and we would need to be breaking below this price sensitivity area here to be seeing any deeper corrections to the 1980s. And the only way I can see that so far this week is if inflation is a lot higher than maximum expectations, fading out the rate cut hopes narrative, bringing impulsive dollar strength, bringing the pressure back on rates up higher for longer, which is, of course, a fundamental bearish factor for gold to play this range, which would still be a very safe adaptive range. But until we have those technical confirms or fundamental confirms, I'm not really the one to be fighting the trend technically or fundamentally here. GJ. Right now, GJ still bullish. Even if we get deeper pullbacks to 183.5, break above current prices, still just continuing the bulls. No major fear, uncertainty, or doubt. Red Sea tensions haven't really brought that much impact to currencies, held more weight on commodities from what we've seen so far. Very nice bullish price action and market structure. I only see a short-term bearish play in correction from 183 down into 181.5, 181.8 handle. But this is still the main plays here, in my opinion. Euro USD and GBP USD. So dollar is still respecting that bearish structure. The same time, Euro USD is still respecting this intraday and higher time frame bullish structure, right? Which, as this is still being respected and we're having these higher highs being printed, if we don't have confirms to bring dollar demand, we could still at least be chugging to these highs, even deeper into the 1.2s before starting to look for some high risk, high reward sells from more of a technical standpoint there, depending on the fundamentals at that time. But for the time being, we're still seeing that similar to this situation, the pullback phase is still coming from a new high being printed. You can see a similar formation in price where you have the bearish price action, but you start to create a support with multiple failures to break a low point, which we're seeing here around 1.09. You see you start to break above a resistance area. You can call it a triple bottom in the leg zone. You can call it an accumulation and break above, but that resistance point here is still around 1.08. So it's a similar price formation where if we don't break back below here, we can still be digging to the same high points, right? And the fundamentals still support that as long as the rate cut hopes narrative's holding the most weight, which so far it is. We haven't had anything defining to shift that narrative or sentiment yet. So I could really only see adaptive sells on Euro USD if we shift structure and break below 1.087. Otherwise, I'm still looking for these pullback or continuation buys from these four intraday zones and two intraday zones and two key levels here. This is going to be a similar idea to GBP USD now, but with GBP USD, you can see as we've been more bullish here, the secondary phase of market structure is more of an accumulation. Here, when we printed these highs, you had a very clear-cut pullback phase and then instantly continued the trend, printed new highs, right? But here you can see we saw a bit more struggle of printing new highs. So since then, the secondary phase of market structure has been an accumulation. With dollar still holding below that 102.8 price point for the time being, if we don't break these lows, or especially if we don't fade out this impulsive bullish move from last week, we could still at least be digging into these same accumulation highs and still potentially even continuing more to the upside. With GBP specifically this week, we have some GDP data later in the week. We have some manufacturing and industrial production data, which is actually expected to show some slight rebounding and can still keep some demand in the British pound alongside this technical structure if it's still being respected by them. So with GBP USD, I don't really want to see a full fade out of this move and correction down to 1.263. That's just pretty volatile and aggressive. I'm not saying it can't happen, but I would, with the amount of retests we've had at this demand zone and around key level that we're holding, and with the impulsive leg up we've had from last week, I would prefer just more of a 50% correction, even though it still is bullish above here. But I would prefer to make it smooth sailing, just the 50% correction down to 269, break above 275, and obviously you have to be careful out 28, but still in bullish market structure, bullish price action for the time being. USD CAD now. We can see oil is still respecting that very important demand zone and price zone around 68 to $70 a barrel. You can just see we're still just in a bit of this corrective pullback phase here, where we had buyers exhausting from the $90 barrel price point. And then we just, of course, had a pullback, short-term sellers in control to drive us down to better prices. If we can see dollar individually still being a bit more bearish, oil starting to dig back above $75 a barrel, which gives some more strength in terms of intermarket correlations to the Canadian dollar, then USD CAD can still be respecting this intraday bearish structure, digging into this zone again before starting to anticipate any buys. So when I'm looking at US 30, even though we had some short-term bulls, when you're understanding structure, it still came from new intraday lows being printed on the rate cut hopes narrative, holding the most weight, dollar being bearish because of that, and oil starting to stabilize, giving the Canadian dollar some strength from that demand zone there. We're looking at crude oil pricing. So USD CAD is still a pullback from these new lows. The pullback hasn't faded or broken market structure yet. And we're still holding below this last bit of an accumulation at 3.4. So from 3.4 or break below 3.31 or 3.32, I'm still short-term bearish on USD CAD. Now, US equities, I don't want to fight the trend. I don't want to fight the stock market greed without reasons for it. If there's a major fear, uncertainty, or doubt catalyst overnight during London session while I'm snoring and snoozing, by all means, adapt to US 30 sells, adapt to gold buys, adapt to Japanese yen strength, and so forth, right? More demand in safe havens, less demand in risk assets. If we get some major banks failing overnight, huge world war escalations, an alien invasion, a cyber crisis, and I'm sleeping through it, adapt accordingly. But I don't like to play in those types of hopes and dream predictions. For now, stock markets are still optimistic, still in bullish structure, dollar still respecting bearish structure, yen still respecting bearish structure, volatility index, which is our fear, uncertainty, and doubt indicator, or another indication of that, is still bearish as well. US 30, even if we retest 37 150s again, break back above 37 500s, break above 37 800s, still short-term bullish on the stock market, playing this rate cuts narrative and the greed we've seen from November onward. All right, everybody. So I don't want to yap too much. It's almost been like 45 minutes to an hour, but hopefully you guys enjoy the weekly recap, some of the fundamental refreshers, the technical market structure and price action analysis, trade ideas, and everything else in between. Any questions, complaints, problems, issues, comments, trade ideas of your own, debates? Let me know now in the next minute or two. Otherwise, I'm going to save and upload this and then send this will be available first on Vimeo before I send the link to the main feed. And then I'll obviously send the rest of the weekly flow shortly too, all the events we have in focus, market sentiment analysis, and everything. But I like to do these webinars with everybody just because it's pretty much covering everything we're gonna send in the weekly flow in this singular webinar. You know what I mean? So it's nice to go through it together like that. The GBP data is on, I'm gonna send the calendar anyways, but while we're here, the important GBP data this week, which is some GDP, gross domestic and industrial production and manufacturing output. This is on January 12th, the day after the US CPI data. So January 11th onward is looking like when we should get some more volume volatility. Doesn't mean we can't have some trade ideas in the first half of the week, but my expectations through experience and understanding how the markets have been following economic events to get policy signals from the central banks is it looks like we'll get some more fun with CPI. Can't forget jobless claims the same time, but CPI, the main one on January 11th. For the British pound, UK economic data, GDP, industrial output, manufacturing output, expecting pretty optimistic data across the board, maybe a slight decline in GDP. Producer price index data um during the New York session on January 12th. And then that's pretty much it. Besides CPI, it is a little bit of a quiet week if we don't get any reactive events. I don't think we have any Fed speakers planned here tomorrow. For the rest of the week, it's looking pretty slim pickings as well. Is my thing off here or something? Yeah, I don't see any Fed speakers this week at all, actually. Unless this is glitching out. Yeah. All right, so I'll let this save and I'll upload it to Vimeo. I don't see any more questions, I think, so we're good. Thank you for your time. No, thank you for your time. Appreciate it. I just gotta send the rest of the weekly flow while this uploads.